All right, everyone, welcome back for another episode of Carnivore Trades. My name is Aaron Basil, and this is my long-term technical analysis of the price of gold. So I've been talking about this for a couple of weeks now, and finally getting this one out to you. So without further ado, to start off here, so we need to determine what phase we are in the cyclical bull market of gold. So you see right now, what we've done over the last couple of years, we put in this low in 2018. We've had a nice run up. And then you got parabolic, and now you're pulling back into your 20 moving average on the monthly time frame. Now the question is, are we in a January to June of 1980 type period where we went parabolic, pulled back, and then we got a nice bounce, and then ultimately rolled over for many years? Similarly, in 2011, 2012, we did sort of the same thing. You have this engulfing reversal after the big move up, pulled back, and then got a nice pop, but then ultimately rolled over for pretty much the better part of the last decade. Or are we in a sort of October 2006 or a November 2008 scenario where we had the parabolic move, we pull back, and then we thrusted higher? Same thing here. You pull back, big flush out, and then you thrusted higher. So that's really the million-dollar question: is gold going to make new all-time highs, or is it going to fizzle out and go into another bear? I asked myself this question last year after we had broken $2,000 an ounce, and after a year of studying, I believe I have an answer to that. But first, let's talk about a few things here and how I knew that 1700 to 1800 would be a major tradable bottom. So you can see here, I'm not a big Fibonacci fan guy, but on long-term time frames, they do tend to tell you quite a bit, and I think this is a very cool pattern here. So we're going to use the Fib fan, and we're taking the low from 1999, which is when the cyclical bull market started again in gold. This is when the gold market bottomed, and I have the peak in 2008. And basically the way the fan works is it essentially just projects retracements from the peak to the trough. So as you can see, even before we made this all-time high, the Fibonacci sequence lines up. Notice how you came up, and then you found a natural resistance at the second level, and then you hugged the first level, thrusted higher, found resistance at the third level, came back down, back tested the first, and then you blew up here. And we came back down, crashed through the first, found support at the second, and then we basically hugged the first line for several years before blasting off again. And then you got up to the all-time high again, back to the third level, and now you've retraced to the second level. Also, you see the white line here, obviously, a major pivot coinciding with this Fib fan area told me that we are likely to have a major bottom in the gold market. Now, whether that was short-term or long-term was kind of irrelevant, because what matters is that you can make at least a swing trade off of this, which I have. If you guys have been following me on Twitter, you know I've been trading WPM, Agnico Eagle, GDX. I've made money off of this low, and it was a good trade setup. But we're here to talk about the long-term projections. Also, coinciding with this fan level, if we just flip over to a smaller time frame here, you can also see, if you take your March low, draw a fib here, it also is a perfect 0.618, and it's a retest of this previous breakout level. So you've got four factors of support. You've got the monthly 20 MA, you've got a 618 retrace here, you've got a 20-year Fib fan going back to 1999. On the weekly chart, you have the 100 moving average. You actually have more than four factors. So this is a high percentage trade. This is a trade that we look for. This is a trade that we want to be involved in. So now you can see where I found the bottom here. and how I found the bottom. And so now we're going to look for some symmetry in the charts here. If we pull back, all the way back, you can see that all the way from the 70s run up, 1980, all the way really until the mid-2000s. The breakout occurred in 2007, but really this pattern here is more or less a sort of giant cup and handle. It's a giant one, it's a big one, and it's not the prettiest pattern, but it's there. You can see here's your cup, your base, and then here's your little mini handle at the end. You even kind of did the same thing here in 2008. After the breakout, when you retested the breakout level, you put in another kind of cup and handle. But the important thing is you have a giant cup and handle pattern here. Now from 1980 to 2000, it's 20 years. It took you 20 years before you put in this pivot low here. And eventually that was the multi-decade low that we still have not taken out, and that started the cyclical bull market. Well, here we have a similar pattern, obviously. We all know about the giant cup and handle. It's been talked about many times over. In this case, you peaked in 2011 and you bottomed at the end of 2015. So approximately 4 or 5 years. Essentially, you cut the amount of time it took for this pattern to play out and increased it exponentially. It only took 4 or 5 years or so for gold to bottom this time, as opposed to the previous bear market. What that's telling us is the price of gold is increasing with the amount of central bank money printing. Remember, 1999 was the peak of the tech bubble, and Greenspan started lowering rates and lowering rates and lowering rates to ease the conditions after the bubble burst. And then again in 2007 and so on and so forth. We know QE happened, obviously. But what this tells you is that the waves are getting closer and closer together. The markets, what took gold 20 years to do before is taking it 5 years to do now. And that's a testament to all the money printing that has happened. So the acceleration of money printing is putting upward pressure on the price of gold in the long term. And I currently believe that we are in somewhere in this phase or stage of the bull market. I think we're in a really sweet spot here. And I think there is going to be opportunities in the gold market. I think there are opportunities in the gold market right now, as I think we have another major leg higher over the next 18 to 36 months. Now remember, if this was your low in 2008 and it took 3 years to put in this peak, but the acceleration of money printing turned this bear market of 20 years, or 27 years really, into this bear market, which only took 10 years, then you'd have to think that it may not even take 3 years or 36 months. It could take 18 months to have a similar move to the one we saw from 2008 to 2011. But more on that later. Let's talk about why I think this is where we are in the bull market. So if we take a fib retrace, again, gold just seems to love these Fibonacci levels, by the way. If we take a fib retrace from the 1999 low all the way to the 2011 high, first of all, you can see it lining up perfectly with the 75% retrace. But moreover, we take this fib and move it here, you can see that it retraced to a 0.382 and it back tested this previous consolidation and breakout area. So all it did was, this was a pretty big flush on the shorter time frame. So on the monthly time frame, all you did is basically pierce the 20 MA and kind of kiss the 50, but you hit the 382 retrace. Now if you take this low here and bring it up to last year's high, what did you do? Oh, tested the 20 moving average and a 0.382 retrace. So we're seeing the same exact pattern play out. By the way, notice how this is an exact 100% retrace of this. Cool stuff. Charts have memories, so you always see charts. Charts always have memories, and they always go back and test previous levels. They love to do that. But anyway, you see the symmetry here. I believe that we are pushing higher, setting up to ultimately make another leg up. Now, what makes this different? What makes it different from this area here in 2011 where we went to a bear? Well, the symmetry is not there. You do the fib retrace, and you had your 25% retrace, but not the 382. And notice back here as well. We go back to the 70s. This was a 50% retrace. So you're seeing the symmetry being off in the cases of the bear markets, or the beginning of the bear markets, or the blow-off top phase, like 2011 and 1980. The symmetry is different. This time, the symmetry is exactly the way it was in 2008. So with that said, let's talk some price targets here. Now, finding a concrete price target is kind of tricky because we don't exactly know where we are in the bull market. I believe we're in this area, but we could be right here. And if we are right here, then that adjusts our price target very much so. And in fact, it actually gets even more ridiculous. So if we were in this area, which is also a 0.382 retrace, if you'll notice here, that would imply we have another leg up, which would then be right here, and then we would have another flush and another push. So we take the low here of 250, and we just run it up to 1,000. There's 4x. So you get 4x returns. And then you take this here, about 681 to 1923. It's about just under 3x. It's 282% returns. So you'd have a 4x move and then a 3x move. So if this would be your starting point right here, remember, this is the cup and handle. This is the low point of the cup and handle. If this is the same type of cup and handle, just shortened because of all the money printing and acceleration, and the acceleration of the bull market cycles, then this is your low point here. So taking this low point, get 1050 times 4, well, that is 4,200. So that would imply a move from here to 4,200, and then another move from 4,200 to about 12,600, 12,000 roughly is 4,200 times 3. In fact, if we can get it more exact, 4,200 times 2.82, 11,800. Okay, so just under 12,000. Now that would be obviously the uber bullish case, but that would take a little bit longer to play out. Obviously, as this would be where we are now, so we'd have a full leg here, and then a retrace, and then another leg. Either way, I am calling for, I'll go on record and say that I am calling for the price of gold to reach at least $2,700 to $3,000 an ounce in the next 18 months. And I say 2,700 at the low end because gold seems to like these multiples of 9 very much. Notice here you've had resistance at about 900 and you consolidated, and then from this point on you doubled to 18, and 1800 was really the big level for a very long time, and then again the 1800 there. And if you just assume that this bar right here was the breakout above 1800, Then you just add another $900 and you come up with 2,700. So I think on the low end, just using that type of a measured move, you'd get at least 2,700. But I think that based on the analysis I've done, we're more likely to breach 3,000 in the coming years, if not by sometime next year. So that is my long-term forecast on gold. And I just want to throw in a little bonus here. We're going to take a look at the GDX. Just give me 1 second here while I pull this up. And this is a bonus because not only does it support the thesis here for gold, but there's also a little bit of education packed in here as well. So if we look at the GDX here, let's actually pull it back just a little more. There we go. So we're looking at a longer term chart of GDX. Now, you may have seen this chart circulating the internet a little bit. A lot of people were talking about it, but what we can see here is a very clear head and shoulders pattern on the GDX. And this pattern was circulating the internet. And these head and shoulders patterns have the tendency to fail more often when they're very easy to see. When it's clear as day, it's strikingly obvious. And needless to say, this pattern has failed. Now, why this is relevant is that anytime you have any sort of failed pattern, whether that's a bull flag, an inside bar, head and shoulders, a wedge, whatever it is, anytime those patterns fail, it almost always results in a violent move in the opposite direction. So if you have a bear flag that fails, you would expect a very robust move to the upside. Likewise, a bullish inside bar fails, you'd expect a bear move to take place from there. Well, in this case, we have this head and shoulders on the GDX. That pattern triggered. It found support at the 100 moving average. Notice these previous pivots right here, tons of support. And really, going back to 2013, there's a lot of support there as well. And really just back testing the breakout. Now, why did this pattern fail? Because the bigger time frame was not confirming it. And that's a mistake that the vast majority of traders make, is they see patterns on the daily or the intraday and they don't look at the weekly or monthly chart. And that's going to tell you the bigger picture, and that's why those patterns fail. So you had the head and shoulders on GDX trigger, and you went right into this massive support level going back to 2013. And really all GDX did was just back test the breakout. And now it's moving higher. And you can see the same thing on the GDXJ as well, which, by the way, is incredibly cheap right now. Look at where the GDX is trading. Look at where it was in 2010 compared to where it is now. So this is a good area to be in if you want to get leverage to future $3,000 an ounce prices of gold. Because not only would the price of gold be increasing by about 50%, but the GDXJ has all this catching up to do just to get back to where it was when gold was 1,900 an ounce the first time around. And you can see this nice cup and handle breakout pattern. You have the cup and then the breakout, and now a little back test, and you're curling back up with the handle. And it's the same thing here really with the GDX as well. So that's my little bonus for you. If you're looking for other areas to be in as far as leverage, you cannot go wrong with the streaming and royalty companies. Wheat and precious metals, obviously the big one. And another one that is very nice is Sandstorm, that also has some exposure to copper as well. But this is one of my favorite charts here. I was watching this. If you guys are following me on Twitter, I was pointing this chart out for months. I love this wedge pattern. I mean, this is just such a pretty chart here. Not only do you have that, but look at the perfect 0.618 retrace, and it went right there. And as soon as you hit that 618, it was blast off. So really cool stuff here. Love the symmetry of the charts. And now lastly, you might say, well, Aaron, I thought you were forecasting higher yields in the future. How can that be if you're expecting gold to break out? It's a very important question to ask, and it's a good question, but I think I've got you covered there as well. So if we go back and we just do a little comparison here. And just pop in good old TNX. Now obviously gold has a inverse correlation with yields. However, there are pockets of time where gold and yields can move higher together, whether that is due to the market being concerned about inflation or what have you. But as you can see, what's the only time on this chart where gold and yields traded with a positive correlation? That's right, October 2008 through 2010, which is where I think we are in the cyclical bull market. So if you notice, yields came down. Yields came down and gold bottomed, and they both moved higher in lockstep. And then the correlation flipped back to a traditional correlation of being a negative divergence, and bond yields went lower and gold continued higher for another almost 2 years. That said, you guys know where I stand now. I am predicting $3,000 an ounce or more in the next 18 or so months, and I think that we are in the midst of a consolidation phase, much like 2008, 2009, before making another massive leg higher. So that is my long-term chart analysis of gold. Really hope you guys enjoyed it. Let me know what you guys think in the comments, and I will talk to you guys later. Thank you.